If you recently purchased, built, or heavily renovated an assisted living facility, a clinic, or a commercial healthcare building, your generic accountant is actively trapping your cash flow. Right now, they are putting your massive building purchase on a standard 39-year depreciation schedule. That means you are getting tiny, meaningless tax write-offs trickled out over 4 decades, while you are suffocating for cash flow today. But the wealthiest healthcare owners don't do this. They use a completely legal IRS loophole to front-load those deductions. Welcome back to the channel. I'm Larry Davis, EA, your Healthcare CFO. After serving in the Marine Corps, I built tax help to protect the profits and assets of healthcare owners like you. Today, I am going to reveal the ultimate wealth-building tax strategy in real estate, cost segregation. I'll show you how to legally write off hundreds of thousands of dollars in your very first year of ownership. When you buy a $1.5 million commercial building for your assisted living business, the IRS says the physical structure deteriorates over 39 years. So, what does your generic CPA do? They take the purchase price, subtract the land value, and simply divide the rest by 39. You get a microscopic $30,000 tax deduction every year. It's called straight-line depreciation. But here is the massive flaw in that logic. Your entire property is not just 4 walls and a roof. Think about the inside of your healthcare facility. You have specialized commercial vinyl flooring, heavy-duty HVAC systems, ADA-compliant walk-in showers, specialized medical cabinetry, advanced security systems, and commercial kitchen equipment. Do those things last 39 years? Absolutely not. They need to be replaced in 5, 7, or 15 years. So why are you letting your CPA write them off over 39 years? This is where cost segregation changes your life. Cost segregation is an IRS-approved engineering study. We literally bring in structural engineers to tear apart your building's purchase price on paper. They separate the structural components from the personal property and land improvements. We move your specialized plumbing, medical electrical wiring, fencing, and parking lot paving out of the 39-year bucket and drop them into 5, 7, and 15-year depreciation buckets. And when you combine this with bonus depreciation rules, the results are staggering. Instead of waiting decades for that money, you can accelerate massive amounts of depreciation into year 1. I have seen healthcare owners turn a $30,000 standard write-off into a $300,000 or even $400,000 massive tax deduction in a single year. That is hundreds of thousands of dollars staying in your bank account right now, so you can buy your next facility, hire better staff, or simply secure your wealth.